All right, so I'm getting started. Hello, everybody. Jamie Settele here with the FX Street Market Overview webinar. I have not done been doing webinars for SB Trade Desk, of course, for a while, and I used to do webinars for Daily FX, but it's been a while since I've done a webinar outside of SB Trade Desk, so this will be fun. So just to make sure you guys can all see the DXY chart here, right? Okay, good. All right, so the DXY chart, I'm starting off with an extremely crazy long-term chart. It's extremely clear from the sense that what we're looking at are simply the long-term cycles, basically since the end of Bretton Woods, and pretty clear in the sense that, look, the dollar tends to go through roughly, call it 9-year cycles, 7 to 9-year cycles, right? So we have the first phase, the downtrend, 9 years, all right, from 1969 to 1978, and we bottomed, and then you had a massive uptrend, the strongest uptrend you've ever had for the dollar, and that took us down or up into 1985, and the Plaza Accord happened after the top, actually, but then the next downtrend lasted 7 years. Most all of it was the first 3 years off the top, of course. All right, and then you had choppy sideways, but from low to high, you had a 9-year advance, and then a 7-year decline from 2001 into 2008. And sideways really for, really until 2014, but from low to high, it was another 8 years. I guess you could say it was 9 years because we actually topped on the first day of 2017. So by this logic or, observation, quite simply, I see us in another downtrend, right? This is year 2 of a dollar downtrend. Is the way I am kind of looking at this from a very big picture perspective. Okay, now, does that mean that we are going to go straight down like we did here in 2002, 3, and 4, or 1985, 6, and 7? Not necessarily, although it's certainly possible, right? So this obviously is not something that you necessarily trade off of, but consider it my fundamental analysis, right? It's my big picture fundamental take in that we are in a kind of a secular downtrend or, a cyclical downtrend in the dollar. So moving on, let's zoom into some levels. So DXY, we can look at some dailies, weeklies, and then zoom down from there. So I like to kind of, go big picture first and then zoom down. So if we're looking at the structure of the move from 2008, okay? We have hit, back in February, we did hit a well-defined spot for the dollar to bounce, and it has bounced, although it hasn't done anything since then. Now, of course, remember when you are looking at, DXY, it's essentially a European against European currencies. Okay, you're going to see, 57% of this is euro, so it's mostly, pertains to euro here, but we're looking at it from a standpoint of kind of, general dollar direction on that DXY front, right? The long-term cycles. So from here, we are in a somewhat of a tricky situation because, again, it's sideways. My, initial thought simply is that it's sideways. It's going to resolve lower because, again, we are in a downtrend. So downtrend, sideways, and then lower. And this is a relatively weak bounce, right, in the grand scheme of things. Going down to daily, this is the channel that we're working with, okay? It's simply the trend line from the highs back in 2017, right? The first 2 highs. Now, we'll talk more about this on Thursday when I give the presentation, The Power of Parallels. But you can see, we call this the original slope, Okay, it's simply the trend defining angle. So the first trend line off the high, you do tend to react to angles off of that. And this is a strong downtrend from the sense that you're breaking below the lower parallel of the channel and then finding resistance at lower levels, not even getting up to the upper parallel of the channel. Okay, back in November, we found resistance. There's actually a confluence of slope lines. This is a median line that goes back from this structure that starts back in March 2015, which of course was the a big euro low. But you can see even recently this has come into play, right? You've had the center line from this channel. You can see all the touches around it and the kind of resumption of weakness that we've had on a number of occasions, including in June of last year, June of 2017. And then, of course, very recently in January. And just last week, I guess, or 2 weeks ago, that was Friday, that was 4/6. I believe that was NFP day. And we did reverse off of the median line precisely. Okay, so from here, I see it as sideways and then eventually going lower. The thing with median lines and trading around, with median lines is you're trying to trade around the edges. So you're trying to, get yourself reward to risk opportunities. And a lot of it is based on the entry. Okay, a lot of it is just the risk part of the trade. So you're giving yourself really not a whole lot of a room for error on the entry. So in this case, if I'm looking at, DXY, and we'll look at euro in a second, you'll see exactly what I mean. But I'm treating this as a triangle. So we can zoom in a little bit more. Go down to a 240-minute chart. Let's put the average in here too. Throw a 200 period average in here. Always like the 200 period average, no matter the time frame. All right. So we're looking at this. You can see quite clearly from an Elliott wave standpoint. This is as corrective as it gets. Okay, everything from the February low is in 3 waves. This is in 3 waves. This is in 3 waves. This is in 3 waves, and this is in 3 waves. All right, we could bounce here and get ourselves another 3-wave move back up into the median line. All right, at that point, we could count this as probably a completed triangle, A, B, C, D, looking for an E wave bounce, probably from last night's low. In Europe, you had a pretty decent reversal there, and then we'd be looking for DXY to roll over yet again. All right. So that is DXY, and that is what I am looking at with respect to the dollar index heading into the next few days and beyond. All right, let's go to euro. All right. Euro. This is log scale. We're looking at log scale. It's a very long-term chart, so we are looking at log scale. If you looked at arithmetic scale, it would look like this. Okay. Now, that's not to say that looking at arithmetic scale is completely wrong. Okay. For example, the downtrend from the 2008 high, you notice that I have it drawn off this high and not this high. This high was very, it's kind of a spike, very short-lived. I remember it pretty well, actually. And you had just a quick spike. So I'm using this as the high back here in April 2008. That's kind of important because it defines the angle for this entire downtrend. All right. Now, if you're looking at arithmetic scale, look where we topped, right up here. Okay, so we've been consolidating on this. So I say that arithmetic scale and log scale, looking at longer term charts, you naturally probably want to look at log scale, but I don't think there's like a completely 100% right answer either. Okay. Because if you ignored this, you would have missed a lot of really good opportunities within this channel. I mean, just look at the median line of this channel. It was resistance back on August 2015. That was the ETF kind of flash crash, if you recall, the China reval crash, as they call it, and then it was resistance throughout 2016, and it was perfect resistance. That was the election right there. That was November 2016. Okay, and then once we broke through it, we were kind of on our way, right? This was, I believe, the French election right here last April, so pretty much a year ago exactly. And then we broke through it, and then we've been on our way, and we carried ourselves up into the upper parallel or channel resistance perfectly. Here's what log scale looks like. Log scale, you can see it actually is a bit better on the lows because you never reach it down here on arithmetic scale. So log scale still says, we might have some room to go before we can face another resistance area. And this is actually what I'm looking at with the triangle scenario, right? So here's another reason to suspect that we, that we are, or why we are in a triangle. Triangles tend to relate to each other. The alternating legs of the triangles tend to relate by 61.8. Okay, so if this is our A wave, our C wave would be roughly 61.8 of wave A, and it is, right? If this is our B wave and this is our D wave would be roughly 61.8 of wave B. And guess what? It is. In fact, it is to the tick last night, right here. So we can use this to look for 61.8 of this leg, or the alternating leg, gets you 22.52. That might be where we're headed. So you might want to mark that down. Pretty good time to do this webinar, I guess, with the triangle example, because I think we're probably entering the end of it. And if we are, we're going to get a hell of an opportunity to buy euro about 100 pips lower. Okay. So that is what I'm looking at with respect to euro. You can see the trend line here, false break, probably going to come back down to it again. And if you do, give me just a minute here. This is a method, it's called sliding, using a sliding parallel. And you can see that it actually be more like 2280 or so, which is actually another area that we're looking at. So 2250, 2280. All right. So that is what my thought process is with euro. I'm looking for the triangle to complete. And obviously you can't really break below this level here. Otherwise, what you're looking at is not a bullish triangle, more than likely. Okay. I want to bring in a different chart to show you so this is a chart of range size. Let's do it on a weekly basis, actually. We'll do it on a weekly basis here. So let's go to 13. All right, so you can see that I'll do it based on last week's close. 1.94%. So what I'm doing here is I know that the market's been super quiet, but trying to quantify it to get an idea of, how much coiled energy there is, so to speak. And the 13-week range size as of last week's close, I don't want to do on this week's close because this week's not over yet, but the 13-week range size is 1.94%. That's really low. Okay. Again, that's based on a 13-week range of closing weekly prices, really cutting out the noise. The red dots show me when we've had a range size over 13 weeks that small. You can see that it happened back here in 2002. That was very similar perhaps to where we actually are right now. You can see that that was at the end of, what you can call maybe a triangle, but whatever, sideways quiet consolidation. What happened after that? Uptrend resumed. Similar back in 2006, right? Uptrend, sideways, very quiet, uptrend resumed. And then we had this range size for a period back in 2014. This was just kind of pure hell. I recall from trading euro, we had this tight range, resumed higher. It failed at a trend line, of course, right? Failed right there. And then this was Draghi, ECB, topped in May of 2014, and then we went a lot lower. So all I know here is that we are in an extremely coiled market, and that indicates potential for a sizable breakout move. Okay, it does not tell us the direction. It's possible that you could have a fake out like you did back here, but it does tell us to expect a return to kind of a more volatile trend market, because the market has been trendless to the point that it's, trendless to the extreme, right? So I know that we want to be concentrating on euro, as this triangle, what I think is a bullish triangle, plays out, right? Because the potential for a sharp, strong trending move is there. Okay. All right. So back to normal stuff. Let's take a look at the British pound, which has been on a hell of a run. Jess, how are you? Says, nice to see your work again. Yeah, it's nice to be presenting to everyone. All right. We'll take a look. And here's cable. All right. Cable's been on a heck of a tear. Here's the long-term chart at a massive, massive price point. This is a 200-week average. At times, it's been fairly precise in its identification of turning points. Okay, I say at times because it's not always the case, of course. You can have spikes through it, like you did back here. You can have kind of perfection, like you did here, or like you did back here in 2015. We'll look at the COT in a little bit. I want to save that for kind of towards the end of the presentation. But I will mention that is kind of one of my concerns here with cable, is that the speculative position is extremely long, right? It's quite heavy on the long side, and commercials are the opposite. And at turns, that's kind of the ownership profile that you'll see for a more important market turn, right? You'll have at a top, you'll have specs really long and commercials short. At a bottom, the opposite. So that is something to keep in mind up here. I haven't seen like any of the short-term DSI figures or anything like that, but my guess is that they're getting up there. So anyway, on a long-term perspective, long-term basis, there is a big level to pay attention to. It's 145.66. That is the April 2015 low, so 3 years ago. That's interesting because if you get to that level, you would have a rate of change on a 3-year basis of 0 that tends to act as resistance in its own right. So that's the big level to pay attention to, especially if you get there this month. Daily chart, levels. We are just looking at a channel, very clean channel with a lot of solid reactions on the parallels within it. You can see the median line here. So my trading strategy, or what I wrote to our clients at SB on a Sunday night was, there are two levels that I want to know this week, right? That is the high right here, which we've gone through, and we are now pulling back a bit. And the next one is 140, 145. 140, 145 is this high here. It's 216. It's also the median line, and you can see just how precise at times this level's been as resistance, right? Even back here recently, and then we took off on the upside. So Let's go back to a 240-minute chart, 4-hour chart. You can see the recent trading around it, kind of the resistance, support, resistance, the breakout, right? If we were to come back into this level, especially on a 3-wave drop, I'd be looking for support to go higher. So that is my thought on cable. Essentially, it's kind of the same as euro from but it's kind of buy a dip, right? Two very different patterns, if you will. I mean, euro's been tight and nothing, and pound's been on the charge, but they both offer opportunities, I think, to to look higher, albeit on some weakness. Okay. Okay, let's take a look at the Australian dollar. Aussie dollar's been a bit frustrating over the last few years, from the sense that, I pay attention and trade many different markets. Okay, so copper, different countries, ETFs, and when you're looking at, say, FXI, which is the Chinese large cap China equity ETF, right, or copper, and you have these bullish views. Well, you would think the Australian dollar, historically, with the way they trade with those, the relationship with those markets, you would have more of a run, and we really haven't had much of a run. I mean, compare this to copper. Yeah, at times the turns are pretty good, right? They line up, but copper's gone on a huge run. The Australian dollar really has not done all that much. I mean, this is not that much to write home about, right? You're talking 1,000 pips since the 2016 low, but very choppy. Okay, so the jury for me is still out on whether or not Aussie gets up and out of here. But this is the weekly chart. We continue to kind of respect this longer term trend line. One possibility, or something I would kind of watch out for, is if you did break this, then you're still going to have potential support on this longer term lower parallel. This is just the channel all the way back to the 2011 high. You can see the supports on that 2013, 2014, and somewhat back in late 2017, although obviously not very precise there, cutting through those levels, for four or so weeks before you finally got out of it. But that would take you below here, and you could get kind of a big bear trap. So just something to be aware of. On the daily chart, kind of looking at this maybe as might be a diagonal. Okay, let's go to, here we go. All right, so we are looking now at, this is a 4-hour chart, but that works. Could have an A, a B, and then an ending diagonal from up here from 216, which would be 1, 2, 3. This might be a 4, and then lower in 5, right, to get your C wave drop and potentially test this level, undercut the lows. You can see that if you do a 2 equal legs from here, you would get 76.12, which would be just below the trend line from back in 2016. Okay. So from here, I guess you could potentially have a short opportunity, but it's such a quiet market. I just hate these extremely quiet markets because a lot of my strategy depends on getting in the trade and having it move in your direction quickly. Well, these market kind of just goes to a level and doesn't really do anything. But in any case, that's certainly a possibility. A, B, and then ending diagonal C. 1, 2, 3. This would be 4, looking lower, and 5 for a tag of your trend line. Kiwi might be a better short over the very short term. We actually are short here, and longer term, I actually think Kiwi could be quite impressive on the upside. But you have a run higher, and then essentially you're working on a nearly 2-year just kind of rectangle box, if you will, right? An expanding, range, take out the high, take out the low, and then slingshot higher. But, very, very short term, as in like a couple days. We did run into a well-defined level. One of our little tricks here, we call it the daily reversal resistance or daily reversal support. And essentially you take your high day, right? In this case, this was the high day on 216, and just draw a line over it, right? And that tends to act as resistance or support when you're in a range. So in this case, we're obviously in a range, and you can see that we topped right on that. I guess that was Friday, put in a little reversal day, and I guess you could say we're trying to follow through on the downside here today. Not looking for a whole lot here. I would actually look at the 55-day average as potential support down here, right? You can see how you've kind of been riding along that somewhat since early March. Dollar CAD. All right, we're going to scroll way back here. Dollar CAD is a perfect example of respecting its channels on really quite a long-term basis. So you draw your channel back from the 2012 low. I mean, this trend line, first of all, it's extremely well defined. And guess what? It's still in play today. Okay. You can see that the channels itself, the upper parallel, support with precision in May of 2015, support again with precision in May of 2016. The center line from that channel, or the median line, a lot of trading around it, right? A lot of trading around it recently, just over the last year or so. So this is in August of last year, resistance. This is throughout October and November. And then this is just recently, right? March 19th, right here. So extremely impressive the way that the dollar CAD has traded on its long-term parallels. And this is that line down here. This is the original line here. We'll make it nice and colorful so that we can all see it. And you can see that, yes, this line goes back to 2012, but it's still in play as a potential resistance at this point because you're below it. So if we did get a bounce, back towards, say, 127, I'd actually be looking at that as resistance for a short and continuation, maybe down towards 124, which, again, this is a sliding parallel. This is a method we'll talk about on Thursday in the power of parallels presentation. But what you're doing here is this is the angle that dollar CAD's trading on and has been trading on for quite some time. So you can see that even the low back here, you slide the parallel down to this low and it nails this low, right? Pretty good stuff. So my levels for dollar CAD on a swing basis, probably 127 and 124, just based on these parallels. Obviously, you are below the 200-day average here, so not sure you're going to get an immediate reaction back up here. But if you were to get back up there, and it doesn't have to be soon, it could be at a later date. But it's just something that I'm always aware of. All right, let's look at some commodities. We'll take a look at crude, and we will take a look at gold and silver. Okay, here is crude oil. The angle that has defined the crude oil market for an extended period of time is your 1986 to 2001 trend line. Okay, that was the low, the bear market in February 2015. January for Brent. The center line of that support for the launch that started last year, right, in June. And then the upper parallel from that has been resistance for a number of important crude oil highs, including 2000, including 2003. And once you go through it, it's for real. It was also pretty decent back here in 2015. So you could, I guess you could, see, what is this? 10 degrees. Let's do this. Try to really get precise with it. 10. All right. So that, you can see, might even offer a little more precision because that's the exact high from 2000 right there. And if you were to get a little higher in crude oil, I think you could have us, this line is 69.30 or so. So if you got $3 more on the upside, man, that would be a short, I think. Obviously, crude oil sentiment is pretty stretched. I mean, on Twitter, which I consider kind of the 21st century trading floor, it was loud, right? Last week with the whole Syria thing, the sentiment was wild. I mean, we've seen that before. Just go to Google, type in crude oil Syria, and actually you can go back and look at past years. In fact, the articles that were written on this day back in August of 2013 are like identical to the articles that were written here last Friday or last week. So, the sentiment is extreme. Obviously, things can remain quite extreme for a while, but we're already seeing crude oil pull back. But I'm just aware of 69, call it 69.30 or so, as a hell of a level for crude if we get up there. Now, here's, if we zoom in, this is the same. This is the same parallel, okay, on the long-term chart here that we were looking at. So, but we're looking at a daily now. And you can see that the channel from June of last year, right? This is a strong bull market, right? On this daily chart, right? This is like the opposite of the dollar, right? You're going through the upper parallel on the highs. You're coming back and finding support right on the center line, right? You did just on April 6th, okay, which was your NFP day. And now we're actually starting to find resistance on the upper parallel here. So that is a bit of a warning because it's kind of like momentum divergence in a way, right? Like a lot of people love to use RSI, and RSI, you get higher price highs, but you have a lower RSI. It's kind of similar with this. And again, this is a concept to go through more on Thursday in the Power of Parallels presentation, but you're not, if this was still an extremely strong bull market, you would want to see the market go up to the sliding parallel that's, related to this line here, right? You want to be getting up here. That's not happening, right? On the last three peaks, we've actually topped on a lower price level. All right. Now, what would say a conservative type of short, right? Like not trying to trade, get short at 69.30 or something like that. What would more of a conservative type of short look like? A setup in crude oil would look like this. Say you broke down, found support again, rallied, and then you found resistance on yet a lower level, right? If you found resistance on a lower level, in other words, not this one, but a lower one, then you would be looking for it to break support on the downside. So just some thoughts there with crude. Again, I would pay close attention to 69.30 if you got it. Yeah, I'll leave it there. All right, let's go to gold. I will tell folks here the exact same thing I've been telling our members, our subscribers for quite a while, and that is wake me up when gold either gets down to like 1307 or above 1375. That's it. That's simple, right? I don't see anything else to do or say about gold until one of these levels is reached, right? 1307, simply because that is support that if we're still in an uptrend, you would want to see hold, and you would be looking, higher off that level to be a buy the dip. 1375 because that's the high from 2016, and that could trigger a massive breakout. It could also trigger a massive breakout because at that point we would have what we call the possibility for median line acceleration, right? Median line acceleration, it's similar to just, breaking a horizontal level, but in this case, it's even stronger because you're breaking an upward sloping angle, in which case it says the market's exceptionally strong. You'd be looking for kind of a big move higher, like a really big move higher, right? This is a valid median line because it's been resistance before, right? It's been resistance back here. In fact, I guess that's exactly 1 year ago. That was April 17th of 2017. And it was resistance back here on January 25th of this year. I'll show you a great example of median line acceleration in gold. So back in 2013, you had a channel that was drawn here. This is drawn a little wonky, so let's fix it. It says like euro. I draw it off this one instead of this one. Anyway, you have, with gold, you had this channel. Okay, you had a bearish channel that was had formed, and you knew it was a bearish channel. It was confirmed after you hit the center line from that channel, which was over here. Okay, now after that happened, right? You test the median, you tested it for roughly, 2 months. And once it went, this is median line acceleration, right? I mean, the gold market threw up. So that's a good example of, what can happen, or kind of the power of these parallels and how they can help you anticipate even the strength of a move. So yes, the very strong moves occur when you go through the median line. Actually, if you go back to the euro chart we were looking at earlier, that same thing happened, right? Once you broke through the median line back last year, May of last year, euro was off to the races. All right, let's take a look at silver. This is much more exciting to me from a potential standpoint. Extremely tight range, like scary tight range. In fact, we could probably do what we did with euro and do something with range size, because it's got to be just crazy. So I'm actually checking that out right now. Let's see here. Okay, let's take a look at that. I will bring that chart over in a second, but range size. Okay, so I will tell you right now, the last time that you had, this is a 52-week range. 52-week range size is 15.59%. Last time you had anything of that, small range on a 52-week basis was all the way back in 2005, which was before you had a big run-up. So, again, if anything, it just shows us the, sorry, let's see here. It shows us the potential, right, for kind of a sizable move to take place in the silver market. So silver is something to keep an eye on. You continue to test this 200-day average. We've been, repelled at it since February. And if we ever get through it, it would be the first sign that something's going on. Really, though, you probably want to see us. I'm actually following this market here, SLV, which is the Silver Trust, right? It's your ETF for silver. And what I'm looking at for the acceleration point is actually here. It's like 1625. That parallel is, one that you kind of traded around as support and whatnot. since December of 2016. So if you can get through there, to me, that's an important development, and that's really what would trigger it to go, or would be my trigger at least. All right. Another thing with silver, we're going to take a look at COT here now. If we even have time, I don't know. But I know I said I was going to look at COT, but I'm not sure if we're going to have enough time. Oh, dollar yen. We never even looked at dollar yen, did we? Should probably do that. All right, let's take a look at dollar yen. All right, dollar yen. Start with our really long-term chart, okay? It's a monthly chart, log scale. Dollar yen, 200-month average. My belief is that dollar yen is in a corrective period from the 2015 high. All right. Now, here's the problem with that. Everything from Brexit, right, is a B wave under this interpretation of price action. So B waves, as we know, are the worst waves from a, I guess, a trend standpoint, right? Doesn't mean they're, it can be great trading opportunities if you can kind of get the pattern right, of course. But point being is that you can have there's a lot of possibilities here, right, for the B wave. In other words, this whole thing could end up as a triangle or something, right? And if that's the case, then we're only in wave B of the triangle. And we could be like, up, we could be higher, lower, higher. I mean, we could really contract and make people mad for an extended period of time. So what I'm doing here is essentially just following this channel for the most part. Let's go to log scale. All right, this is a channel that goes back to 2015. A lot of good touches within it, right? Good support, good resistance. The median line itself here is not really anything to talk about because it hasn't done much. But you can see this line, which we'll call the 75 line. Again, I'll get more into this type of analysis on Thursday. It's what the whole presentation will be about. But that's a good pivot, right? You can see it's a good point of reference, right? You have some spikes on it recently, right? These highs as resistance. And then even last week during that kind of dreadful consolidation, you were kind of trading on it. So my point being is that as long as you're above it, it's really a fight to kind of be short dollar yen, in my opinion. However, if you can get back below it, then you would actually look at that level as resistance, right? And if you were to get back below it, it's pretty easy to envision this level providing resistance, right? Because it's a horizontal level as well. It's the 106 60s, we'll call it, like 106.64. So you've got the high here from 321, the support last week, and if you got back below it, this would turn into resistance again, and you could use that to trade into that level on the short side, right? So to me, not a whole lot to necessarily do right this moment with dollar yen because it's still, it's still supported. Okay, even though you have come into some really solid longer term levels, if you just again look across the chart, right, you can see that this is a very solid spot. Okay, you got even over here. So this is April of 2016, by the way. All right, let's look at, we still have a little bit of time. We can look at some indices. I'm sure folks would like to look at some indices. So here it is. We'll start, I guess, with the S&P. We're kind of going near term here, looking at channels from the, from the highs, and we are all awfully close to a spot where we could turn over. Sorry, it's checking something out here. All right, yeah, we are awfully close to a level where we could, get some sort of a reaction lower in the S&P. Again, not looking for anything special here, but 2711 on SPX is going to be the 618, and then actually, if you were looking at cash, that's essentially the gap, which is on SPY, which is 270.43. So we've reached a level where I think, you probably have the market come off of it. At the same time, I would be looking for support. You can see if we go to hourly, you can see this channel is, really quite useful. This is actually a shift fork. Again, we'll get more into that stuff on Thursday, but symmetry within the forks is what you look for. Support on this line, which is the 25 line. You look for a resistance on the 75 line, and then this would be support again. Or if you're in a very strong market, you would actually find support at the center line, which would be like 26.90. So looking for, resistance up here, 27.11 and change, something like that. And then I'd be looking at 26.90s as kind of a first level, to get out of some sort of a scalp on the short side. All right. Eventually, your trend line up here could be in play, and that would be all the way in the 2740s. So that's the S&P. Let's look at the NASDAQ. NASDAQ 6845 is going to be your resistance level, and that would take you right through this 327 high. Can envision that kind of triggering a quick, a quick top of sorts, right? It's a very obvious level to go take out, tag the fib, and then turn over. You would have the upper parallel from the structure, by the way, which is well defined, be a little higher, 74. The DAX, I've been telling our members that the DAX is one, I think it kind of is the tell, the tell, if you will. If you just draw your channel from 2016, this thing is like, it's picture perfect. I mean, the low 326 was right on it. I mean, like to the tick. So I'd be looking for resistance at the underside of the 200-day, which obviously was support on the way up back in August. And of course, this is the election, U.S. election. It's also the median line just above there. And that's going to be, a level to watch for resistance. You can see it was support before, and it was resistance recently, back in February. And then you've got former lows. So, lows from 12.1, lows from 1.2, right? So your first day of the year low, it's actually important. That would be your opening range for the year. So this whole area right here, I think, is where you get some resistance in the DAX and maybe in stock markets in general. Again, this is the tell in my opinion. So, when it was support down here, kind of lifted everything together. You could have, from a pattern perspective, you could have a flat. So this could be A, 3 waves into a low B, finishing off, C wave, take out, the origin of B high, which would be right here. I think we've done that, haven't we? Yes, we have. We actually did that today. But resistance is a little higher from my vantage point. Nikkei. The Nikkei, the entire thing from 2009 is actually a perfect channel. So a perfect channel. We topped right on it back in January. The center line was support back on Brexit. And this is like the DAX from the standpoint of you have the sharp drop, a rally, 3 waves into a low. So my guess is that you are going to get excuse me, is that you're going to get resistance after you take out the high. In fact, it looks like this. Doesn't look like back in 2015, right? Rally, 3 waves into a low, and then rally, complete a flat. So A, B, C, right? Looking for something similar here, A, B, C. So this would not be considered complete until you take out this high up here, which is 227 high. But again, the DAX is getting awfully close to resistance. So is the S&P, and you have a trend line here. This is the underside of the trend line that goes back to June 2016. Right? It was perfect support back in September of last year, and you can see that we've been riding on it. So you're brushing up against a big area here. You can get through it, fine, and then I'd be looking up towards simply to take out the high from 227 before I look lower again in the Nikkei. All right. I know I said that we were going to look at COT, but I'm not sure we have time to do that. Are there any specific questions over anything that we went over here today? All right. Okay. Well, I hope you enjoyed it. I mean, check us out, SB Trade Desk. I do this every week for our clients, and obviously Mike does short-term webinars 3 times a week, and then we write every day and send out tweets. So a lot of good research, trade ideas and generation, and yeah. I will be doing a premium webinar on Thursday in which we talk specifically about parallels and the different. It's more than just trend lines, right? I mean, there's a lot to glean from how a market trades around its angle and how to find support and resistance with that method specifically. Okay. All right. Thank you all very much for attending. And might see you Thursday, or hopefully I'll see you around sbtradedesk.com. All right. Thank you.